All right, good morning, class. We're off to a start now. Let's get rolling. So, what I want to do is we're going to start right off with chapter one today. I want you to go ahead and log into your Vanco Hall, click on financial accounting, and I want you to go to the first set of PowerPoints that you see there. It says chapter one PowerPoints. So, what we're going to be doing here is we're going to be listening to my lecture. I'm going to go ahead and put this lecture up for you, and we're going to talk about these few slides that we have there. And then I will go ahead and set up a secondary video for this part two PowerPoint slides. Now, keep in mind, we're going to be doing this incrementally. You can do it at your leisure. You can replay these videos as many times as you like to hear what's going on. During your videos, I will give you some tidbits about things that are going to happen, some just helpful hints that'll keep you guys going and help you on your exams when the times come. I will also kind of say some things about homework assignments and things like that. So just kind of pay attention, listen to the lecture, follow along on your slides, and we should all get through this pretty easily. All right, so let's start right there on chapter one, PowerPoints. And if you open them up, your first PowerPoint that comes up, it says chapter one. So let's talk about what accounting is. Well, accounting is a information system that measures, processes, and communicates information about an economic entity. Now, in simple terms, that just means it's the records of the business throughout a period of time, whether it's a year, a month, a quarter, whatever it may be. Every business keeps its records. Now, obviously, every business has to keep records because at the end of the year, it needs to file tax returns and things like that. So accounting is the way that we use all that information on a daily basis gets summarized. So it becomes useful to people. Now, those people we're going to talk about later on, who those people are going to be. Actually, we're going to talk about it right now. The second bullet on the PowerPoint slide says both for external and internal users of financial information. Now, external people, let's talk about who they may be first. An external user of financial information would be like the IRS, New York State sales tax, investors. Those are all people that are external. When we talk about external, we mean outside of the corporation. Okay, if you're an investor, you don't have say on what the company does, what it sells. You chose to invest in that company. The IRS is an external user because they want to know how much money you're making. Okay. The key with them is they want to know how much money you're making so that they can go ahead and tax you. And the purpose for taxes is to run the government and do all the things that, hopefully our government does well or does not well. But neither here nor there. The fact is that they are an external user of financial information. Now, the internal users are people that are within the organization, meaning your CEO, or your district managers. Those are all people that use the information from the accounting to find out, well, are we profitable? Okay, are we making money? If they're not making money, well, then they have to figure out how to transform the company into a profit-making company. Okay, the key here is that that information is crucial. If, for instance, McDonald's realizes that one of their products that they're selling is not selling, well, why keep it on their menu? Okay? So accounting is used by both people inside and outside. All right, the next thing it talks about is accounting measures business activity by recording data for future use. Well, just like I got done saying, a district manager would be using prior data to figure out if something's working. So for instance, we're coming into the fall season here, and one of my favorite companies, because I am a coffeeholic, is Dunkin' Donuts. And this time of the year, for some reason, that obviously fall is changing and pumpkins and Halloween are coming into season. If you look at, say, Dunkin' Donuts menu, you see a lot of like pumpkin spice lattes and all this stuff that has got pumpkin flavors. Well, they know that this is the time of year for that warm, hearty pumpkin type of flavoring, where in the middle of the summer, you don't see pumpkin flavor. Okay, so they've used the data realizing that, okay, this is the time of the year that this sells, and they bring it out this time of year. They make money on it. If you walk through Price Chopper right now, just the other day, they put up 4 or 5 displays, because obviously I'm down in Price Chopper quite a bit. Right by the registers, there are 4 or 5 displays of K-Cup coffee pods. And of course, what do you think this flavor is right now? Pumpkin spice. So they use that information for consumers' buying habits to make themselves more profitable. The other thing that this talks about, it talks about how the data is stored. It's stored until it's needed. Okay. Pretty much you need to prepare your tax return at the end of the year. So all the data is compiled and processed, and then it's finished at the end of the year or at the end of the year for the company, depending on what happens. The other thing, obviously, it says it's communicated via reports to decision makers. Those are all pretty simple things. Nothing too crazy that you got to worry about with all that. Moving on to the second slide. These are 2 terms that I really would like you guys to pay close attention to, and that I will probably ask you for some type of definition from them. The first definition I want you to pay attention to, and the first word, is called profitability. Okay. Now it talks about the ability to earn enough income to attract and hold investment capital. What that simply means is that the company is making money and people are willing to invest in it. All right. If you're an investor, the last thing you want to do is invest in a company that's not making any money, because if they're not making money, chances are you're not going to make any money. Okay. So profitability is one of the business goals that as a business owner you want to be. Obviously, if you're profitable, you're making some money, whether it's $1 or $1 million. But that is one key goal of a business. The second one is what we call liquidity. Okay. Liquidity is the ability to have enough cash to pay your debts when they are due. Now, some companies may not be liquid, but they may be profitable. Okay. The key here is that liquid just means that you have enough cash on hand to pay your debts. But what happens if your company is one of those companies that allows you to sell stuff to people, but you have to wait 30 days for your money? You may not have the money at this very day or time, but you know that the money's coming to you because you've just had a $2 million sale, but you've given them 30 days to pay you. Okay. So liquidity is kind of a shady area. You know, you may have the ability to pay your bills, but just not at the very time. To be the most liquid company is the ones that can pay their bills, literally before they even come due. But just keep in mind profitability and liquidity. Profitability, the ability to make money, and liquidity is the ability to have enough cash to pay your debts when they come due. Okay. Moving on to your third slide. Financial versus managerial. Now, we're in financial accounting, which is the very basics accounting. Managerial is the next step in your accounting lives. Trust me, I understand that for some of you taking this course, or probably most of you, are not accounting majors. So it is one of those things where I understand that you guys, like, oh gosh, I got to take accounting. Like, I'm not an accounting major. Trust me, I understand it. The key that I'm looking for you to get out of this course is you're still going to need some basic understanding of accounting, whether you're in management, whether you're in human resources, anything that you go into pretty much. If you're in hospitality, any of those majors, you're going to need some sort of accounting background. It doesn't have to be where you're going to be preparing financial statements like we're going to be, but you should at least have some basic knowledge of accounting. And that's what this course is in for you to gain. Hopefully you retain it. That's a different story. So financial versus managerial. Management accounting, which is managerial, is mainly for the internal decision makers. Those are people that are in charge of making the decisions, the day-to-day operations. They need this information to run their business. Okay, if they realize that a product line is not selling, that it's costing them money, then it is the management's responsibility to say, well, we are going to discontinue this product. We're no longer going to manufacture, or we're no longer going to carry this product because we don't sell enough of it to make money. Okay. The other thing is that the projections that we use obviously are used to forecast the future and figure out whether we're going to continue doing something or we're not going to do it, just like we spoke about. And the big thing that we do prepare in managerial that is important are things called budgets. Now, like I said, I understand that most of you guys are not accounting majors and care less about this course. You're probably already falling asleep listening to me. You're going to be preparing budgets. Now, the one thing I always say when we talk about budgets is that is something that you're going to learn to do in your personal lives too. Okay. You have to live within your means. So you guys, when you get out of college, hopefully making six figures and paying Social Security so that I can retire someday, you're going to do some budgets on your own. So if you make $4,000 a month, obviously you're not going to be able to have $5,000 worth of expenses a month. Okay. You're going to have to learn to budget your money. You guys are doing it in a very small scale right now. Okay. If, for instance, your parents dropped you off and gave you, say, $500 and said, here, this has got to last you to the first family weekend in October, you would probably have said to yourself, well, I've got 6 weeks before they come back and give me more money. Hopefully that's what they're doing. I can only spend, say, $75 a week. So that means I can buy 230 racks of beer, blah, 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 and maybe go out to McDonald's twice, 3 times, maybe 2 times a week. So you're pretty much doing a budget on your own. So just keep that in mind. It's not as hard as it sounds. And again, it's not as difficult nor anywhere near what you guys are going to make it out to be. Moving on to slide number 4. Financial accounting generates reports. We already spoke about that. Now, the key that I need you to understand is what we call these reports, and they're called financial statements. These are the things that both Wall Street, investors, IRS, and even the managers of a corporation look at. And this is the information they use to make their informed decisions on what to do. Now, there's 4 main financial statements, and in financial accounting, we only prepare 3 of the 4. Okay, those 3, all 4 are listed here, but the ones that we actually prepare in this course are your balance sheet, your income statement, and your statement of retained earnings. The other statement that you see listed there, which is the 4th financial statement, the statement of cash flows, is something that we do in managerial. We do not do it in financials. So the only 3 that you need to be concerned with in this course is going to be your balance sheet, your income statement, and your statement of retained earnings. Okay. Next one, slide 5. We're talking about decision makers. Go ahead and read this slide. I'm not going to read it. I mean, it's pretty simple. Decision makers are the people that, obviously manage or own the business. So, I mean, it's pretty self-forward. So I'm just going to give you a couple seconds to go ahead and read that slide as I take a swig of my coffee. All right, moving on to slide 6. Pretty simple here. Users of direct and indirect financial information. People that use it, investors and creditors. Those are people that are external. And then some other people that use it, which are indirect users, are your taxing authorities, meaning IRS, New York State, so on and so forth. So I'm really not too concerned with that. Now, those first 6 slides are just more informational. There's really not too many questions that I'm going to be asking you from those first 6 slides on your first exam. So just I need to get you guys at a baseline and get you some information in the back of your heads. Now, out of the first 6 slides, the main slide that I need you or want you to pay attention to is the slide number 4 that has the financial statements on it. Understand that we are going to be preparing them. So getting used to hearing the words balance sheet, income statement, and statement of retained earnings is very important. We are going to be preparing them. So keep those 3 in the front of your mind. Okay. Moving on to number 7 here. Slide number 7. We're going to be talking about business transactions. Now, transactions are things that happen every day, but they affect the business very, very importantly. All right. So let's take a look at this one and just kind of follow along. One key that I want to make mention to you right now is I want you to pay attention and try to relate accounting to your personal lives as much as possible. Okay. I will give you examples on how to do that, but I do find that the students that relate accounting or relate these examples to something in their lives do a better job and retain the information more because they actually can relate to it, which is the biggest thing these days. Like I said, I'm going to talk about buying 30 racks and this and that and so on and so forth. But that's all because, not saying that every one of you are out there drinking and partying and having a good time. Obviously, with COVID, not many people are doing anything, which is great. We do want to stop the spread. But, if it was a normal semester, most of the time, some of you guys are going to go out and have a good time. So try to relate it to your personal lives. It'll make this course not so dry. My humor can only go so far, and it's, dry humor. So just kind of bear with me. All right, transactions. The first one. Transactions are events that affect a business financials position. Okay, when you go through McDonald's drive-thru and you buy, say, a 99-cent hamburger, that is a transaction. Okay, that is going to affect McDonald's financial position. Okay, it's going to affect your financial position too because you just paid for something. Now, in respects to McDonald's, they just made a sale. They sold a hamburger, they collected money. So that obviously is going to affect their financial position. As you can see here, it says this could be a purchase, a sale, a payment, a collection, or even a loan. All those things have some type of financial impact on a company. Okay. The way we measure things in accounting is we measure them in terms of money, dollars and cents. Everything reverts back to how quickly or how fast you can change something into cash. So you're going to hear me say cash is king quite a bit because in today's society, cash rules the world. Okay, it's pretty simple. It's just the way it goes. So money is what we use in terms of accounting. I'm not worried a lot about the last thing where it says separate entity. Don't worry about that. The next couple of slides I do want you to pay close attention to because I will ask you some test questions on them. These test questions are very simple. Chances are with the new setup that we're using, it'll be Vanco test right on Vanco Hall. So these are probably going to be multiple choice questions or just fill in the blanks. But pay close attention because this is something that we see quite a bit of right now with the whole COVID thing. You're going to see a lot of your small businesses are closing, probably not going to reopen, but unfortunately, that's the way it goes. So listen to some of the information that I'm going to give you here about businesses. All right, there's 3 main forms of business in the United States. You got your sole proprietor, and then you have corporations, and last but not least, you have your partnerships. Now, those are the 3 main forms. If you go to slide number 9, we're going to start talking about the sole proprietor first. Now, whenever you see the word sole, that means one person, okay? So a sole proprietor is owned by one person. That one person takes all the profits and or the losses from their business, okay? It is their responsibility. It is them doing it. So a sole proprietor Could be any one of you guys that decide, hey, I want to open up a business for myself. Depending on how you set it up, you could be a sole proprietor or you could become a corporation. But sole proprietors are owned by one person. They take all the profits and losses. They're also responsible for all the bills and any obligations, meaning any contracts that you may sign. Okay. They're responsible for it. There's nobody else that can go and be in charge of those. It is that person's responsibility. They're very small in size. Usually sole proprietors, may have an employee or two, but for the most part, sole proprietors are owned by one person and they don't have a lot of employees. They could be a family run mom and pop shop. That's usually what we consider a sole proprietor or a small business. The other thing that I want you to know is that there are more small businesses in the United States than there are any other form of business. The problem is that small businesses don't make as much money as the large corporations do. Okay? If you think about Delhi, and I want you to start at Price Chopper, and for those of you that have gone through the town, this will kind of make some sense to you. I want you to count, and I'll count right along with me. And we're going to go from Price Chopper all the way to, let's go down to, say, the Shire Pub. So if you start at Price Chopper, we're going to count the number of corporations. You've got Price Chopper, you've got Smoker's Choice, Walgreens, Ace, McDonald's, Pizza Hut, Family Dollar, Tractor Supply, Subway, Marabito, Speedway, Country Store. Keep going down, keep going down, keep going down, keep going down. Delhi Telephone Company, and the bank. Sydney Federal Credit Union also. So what's that, about 15 corporations that you see right along Main Street. Now let's talk about the mom and pop shops. You've got the pizzeria, the new Asian Thai food place coming in next to Price Chopper. The Verizon store is independently owned, so that is a small mom and pop shop. Going further down, you got Bagels and Cream. Then you've got Quarter Moon. You've got Good Cheap Foods, the 2 liquor stores, Picks, the real estate agency, that's 10. Then you've got Crossroads, the next real estate agent, which is 12. You go a little bit further. You're at the corner of Division Street, so we're at 7 so far. You got the other pizzeria. You've got Stewart's. You've got Dubbin's on the left-hand side. You've got Delhi Paint and Paper, Main Street Cards and Gifts. You got the Delhi Diner. You have the Tattoo Parlor. You've got the Blue Bee Cafe. Already, we're not even to, let's see, what else do we got there? We got the 2 haircutting places, the Shire Pub, a whole slew of other ones. Couple antique stores there. You've got the new Jay's Place. I think we're close to 20 small businesses. Now, Main Street America is made up of small businesses that you see there. So there's a lot more small businesses than corporations. The problem is that those corporations make most of the money. So that's what I want you to get out of that. If you take a look at the next one, slide number 10, we're talking about partnerships. Partnerships are very similar to sole proprietor, except for the fact that there is more than one owner. You could have 5 partners, you could have 4. It doesn't matter how many partners you have. The key here is that a partnership has 2 or more owners. Okay? If one owner decides to leave, you need to make a new partnership. As soon as one person leaves a partnership, you're required to go ahead and set up a new partnership. The partnership gets assets from both individuals. They don't necessarily have to be physical assets, meaning something that you can touch. One person, you guys may have heard of a friend or somebody else who may have started a business that they know a lot about, but they don't have the money to do it. So they may find somebody who will invest money, and then your friend may be the one that knows how to do the job. There's many restaurants in the world that are backed financially by people that have never cooked a meal in their world in a day, but they get a chef who knows how to cook. He's bringing in the technical experience, but meanwhile, the partner is bringing in the financial stuff that's needed. So partnerships can be developed many different ways and for many different reasons. Okay. The last slide that I'm going to talk about on this video here is going to be number 11. And slide number 11 talks about corporations. Now, corporations are fewer in the United States, but again, corporations make the most money. You know, look at Apple Corporation, for instance. Most of you guys, or some of you guys, probably have some type of Apple device on your wrist, in your pocket, maybe right in front of you. You may be watching this video on an Apple product right now. Okay? They are a major corporation and they make a ton of money. So things about corporations. Corporations are chartered in certain states. A lot of corporations go to the tax-friendly states, such as like Delaware, which is a very business-friendly state. The way that corporations are owned is that they're owned through shares of stock. Now, technically, if you own one share of Apple stock, you are an owner of Apple. You have the right to vote about what goes on. You have the right to go to their meeting, their annual meeting, as a shareholders meeting, not necessarily as like their day-to-day meetings, but you have the right to go to their shareholder meetings, things like that. Corporations allow people that own part of the corporations or own shares of stock, they elect the board of directors. The board of directors is the governing body of a company who put the chief financial officer, CFO, CEO, they're the ones who hire those folks that run the corporation. So the board of directors is a very important role, and we'll get into that later on down the road. Things about corporations I really want you to know. Their liability is limited, okay? So if you buy $1,000 worth of Apple stock, the most that you could possibly lose is that $1,000. If you invest, if you're a sole proprietor, you could lose your $1,000. You could lose your house, your savings. You could lose everything. Okay? As a corporation, the stockholders can only lose the amount of money that they invested. The other thing about corporations, it's easy to sell stock, meaning it's easy to change ownership. In 3 clicks of a mouse, you could buy an Apple stock, and 3 more clicks, you could sell that share of Apple stock, all within a minute. Okay? So corporations are very easy to become a part of and to own part of them. Very easy. The other thing about corporations is they have unlimited life. Different from a sole proprietor. If a sole proprietor dies, obviously the business no longer runs because the person who owns it's dead. Whereas a corporation, we've seen how many different corporation leaders have passed away and their companies are still going. If you look at Steve Jobs, he passed away, no longer with us for probably 10 years now, I'd say almost. Well, Tim Cook is the one who runs Apple. Apple didn't die with Steve Jobs. His legacy is continuing. Here's that part where I was talking about it's small in numbers, but they have the most profits are generated from them. Obviously, using Apple as an example, they're a money-making machine, and they're one company. and they make up probably more than all of Delhi, Oneana make if we were to put them together in a year. Apple's huge. But again, the thing I want you to understand is that corporations, the numbers, they're smaller in numbers, meaning there's less corporations than small businesses, but they make up more money than small businesses do. All right. So I'm going to give you guys a few minutes to go ahead, stretch your legs, put on some tunes, listen to something to get you ready for the second set of this boring lecture. And trust me, the part 2 PowerPoints that we're going to be getting to soon is when we're going to really start the nitty gritty and things that I need you to start writing stuff down and so on and so forth. So go ahead and, take whatever time you want. I'm going to take a few minutes and go ahead and start uploading this video for you. And then I will go ahead and start the second part of these PowerPoint slides. All right, keep in mind, do not be worried. If you may feel like we're going a little fast, you'll be fine. And we'll get everything taken care of. All right, stay safe and talk to you in a few.